Hi, Brendan McCarthy, certified financial planner with Boulevard Wealth Management here. Just want to talk through a question that I get often from clients, and it's about whether putting extra income is better served towards debt or towards putting it into the stock market. So the answer depends on where you're at in your life stage of money, but there are some general rules of thumb to follow. So first off, if you have credit cards or any high interest debt above 8 to 10% or so, you're best served paying that off as quickly as possible, no matter what, before starting investing and even before building a cash reserves. That's going to be important to build your foundation. On the other side of the interest rate spectrum, you've got your mortgage. In many cases, we're seeing mortgages between 3 and 5%. If you were able to refinance before this more recent spike in mortgage rates, if that is the case, you're better off paying those minimum monthly amounts. The only exception there is I typically like to see my clients have a mortgage paid off by the time they launch into retirement. So changing that priority just a bit, 5 to 10 years out from retirement, and trying to get that paid off by retirement is going to be key for your financial success in retirement. All other types of loans are somewhere in the middle. You've got specifically student loans and car loans is what we see often. Interest rates vary pretty widely, but I've seen anywhere from 2 to 8% on those. And the textbook answer often differs from the real life answer. So on paper, it makes sense if I have a loan at 4% and I can invest in the stock market at 8 to 10, then of course I would pay the minimum, invest the difference. I don't like that answer because it doesn't bring real life into the picture. So let's take a look at a couple examples in real life to see two different paths we could take. So, path one, we could accelerate the debt pay down. We could make sure that we're every single dollar extra that we have, we'd pay towards debt. So, in this case, this family has an extra $800 a month of extra income to allocate towards something, whether it be into investments or it be into debt pay down. Again, in this case, we're going to pay down debt as quickly as possible. So we'll use every single dollar, $800 a month towards debt. Again, in here, they'd have the student about $30,000 worth of student loan debt that can be paid off in about 2 years, 2.5 years. And then they can use the remainder to pay off the car loan the following 6 months or so. After that, now they've freed up an additional $2,000 a month. So they have actually $2,800 a month that they can now direct towards investments. The other thing to mention there is not only are they building that flexibility with extra income beyond that 2025 mark, but they also can have given themselves a little bit of wiggle room in their regular budget too. Also, notice here in the bottom, the total value gained of this decision is just over 18 million. So let's take a look at path two. Path two is pay the minimums on all of your debt, save the difference. Again, here, this is a little bit more straightforward. We're saving $800 a month and paying those minimums. And then beyond that, we're going to save an additional $2,000 a month after that debt's paid off. Now, in this case, we've got debt for about 4 to 5 years beyond what we would have otherwise if we had accelerated the debt pay down. But we're starting to build up that non retirement bucket, in some ways, building up kind of a lot of that financial flexibility beyond debt, too. That can be used towards debt. It can also be used towards future major purchases like a car that would avoid you from going into debt in the future. So either way, you are building some sort of flexibility that's important. Again, look in the bottom here, where the value gained here is a very similar amount. Again, a little bit higher to invest and pay the minimums, but we still like to see a similar amount in the value gain. So the point of the exercise is to say there's no one correct answer, necessarily one right path. It's really going to depend on your feelings towards debt and towards investments and towards risk as well. So let me know what questions you have. I'd love to talk about this further. And that's all I've got for you. Thanks.